Analysts say there's a ticking time bomb in housing. A big increase in the number of mortgage delinquencies looms as households renew into higher rates this year and next. Analysis by Canada's National Housing Agency shows mortgage arrears have already started to rise, and it expects significant increases in Toronto and Vancouver over the next 6 to 12 months.
Depending on where you look, the housing market looks like it's either about to collapse or that it's improving. But what's the actual truth? Let's dive into it and look at the numbers. Let's get into it. When we look at the actual face of things in terms of our month-to-month stats, the housing market looks like it's improving. However, we're coming back from such a dramatic low that I'm not sure how impactful that really is. When you look at the grand scheme of things, interest rates are still really, really high. And a lot of Canadians are struggling to put food on the table. And although we did see a huge uptick in sales volume, which was up 44.4% compared to October of last year and 14% when compared to September of this year, we are still in a major slump when you actually look at a larger time horizon going back over the last couple of decades. Let's not forget as well, we have a ton of mortgage renewals about to hit in 2025 that our economy is simply not ready for. We need interest rates to come down significantly, and based on the latest inflation data, I'm not sure we're going to see any dramatic change in December. The next Bank of Canada interest rate announcement is December 11th, and based on the latest inflation data, we have ticked up from 1.6% inflation to 2%. Although that's still within the threshold that we're looking for, I think a bigger Bank of Canada cut of 0.5% is probably off the table at this point. We're heading into the winter months. I think we're going to see a much slower market as we get into the colder months when people don't want to move in general anyways, and people are feeling pretty strapped, especially after the holidays. If we see a few more quarter point drops, maybe we'll have a bustling market come the spring, but even that is still unsure at this time. Looking at pricing overall, we're still back in 2021. Given the unemployment rate right now, we're definitely in stagflation territory, although the government doesn't want to admit it.
We're referring to it at Hayes as the Great Stagnation. It's kind of flat right now. There's nothing really exciting happening. We saw public sector jobs go down a little bit, private sector go up a little bit, construction moved a tiny bit, but there's not a lot happening right now. The market's a bit stuck. We suffer in Canada from the Canadian brain drain, which is a lot of our high-tech graduates from Waterloo or University of Toronto end up going down to the US where you get these massive increases in salary, not just from a dollar standpoint, but on a like-for-like currency basis.
Unemployment is becoming a real big problem, especially among young people. And with inflation hitting in particular food and shelter the hardest, we are kind of primed for a slow winter. But it's not all doom and gloom. We have seen a bit of relief coming, not just from interest rates, but also new regulation that's making it easier to refinance with a different bank without having going through the stress test one more time, as well as also lowering the threshold for CMHC insured mortgages under 20%, all the way up to 1.5 million. It was previously 1 million, and this is going to help people get into the market. However, it's also kind of encouraging them to take on more debt, which at this time is, as we know, extremely dangerous. So I'm going to stay a little bit more cautious when it comes to the real estate market at this current time, and hopefully things turn around in the spring. But again, that's just what I think. Let me know what you think in the comments below. Don't forget to like and subscribe, and I will see you again next time.